Good afternoon. I'm Ayben Koy from Graduate School of Finance, İstanbul Ticaret University. We have a special guest, a distinguished guest today, dear Javier Perez from Bank of Spain. Welcome. How are you, Javier?
Hello, nice meeting you. Hello.
It's very nice to see you again. We had met in a conference in Lisbon last summer, and I'm really happy to have you here as a guest in our Finance Talk series. So I'm sure it will be very interesting for my students, professors, and all the others. So let me give a short information about Javier. And now he is the director of the International Economics and Euro Area Department of the Bank of Spain and member of the International Relations Committee of the Eurosystem. Before joining the Bank of Spain in 2008, he worked at other institutions, including the European Central Bank, the University Pablo de Olavide of Seville, the Research Foundation Center, and the University Complutense of Madrid. He holds a PhD in economics. He also has been member of the Monetary Policy Committee of the Eurosystem and of its substructure dealing with public finances, the Working Group on Public Finance. He contributes to academic conferences, so we have met. And also the main fields of interest are macroeconomics, like European integration, institutions, and geopolitics, and also data analysis. So welcome again. Today you will do a presentation to us about European Union's open strategic autonomy from a central banking perspective. Now, if you want, I can share your document. Okay. Thank you. You can start.
Thank you very much, Professor Koy, Ayben. Thanks a lot for the invitation. It's a pleasure, to be in this virtual meeting with you. Exactly as Ayben was saying, I'm going to talk about basically the interaction between geopolitics, which is a key element nowadays, contributing to defining the macroeconomic landscape worldwide, for obvious reasons. Everybody can see this now. And also the fact that the many countries, areas like the European Union are kind of reacting to the impact of geopolitics and the influence on the economy. And this is kind of configuring, the interaction between these two things, geopolitical shocks, a situation which is changing, and the reaction of regions and countries to these geopolitical shocks from the economic point of view all the time, are kind of changing a bit the landscape in which we have to think about the economy. And this has, in this particular case, has implications for central banks, and this is a bit the basis of a report that we published 1 month and a half or a couple of months ago, in which with the colleagues, as you see, the list of co-authors is long. So if I were just only reading the number of co-authors, I will spoil all the time that I have. So basically, this is a joint work, and we've been thinking thoroughly about this issue because it has far-reaching implications, and I hope that I will be able to kind of transmit the way in which we see this thing. No? So basically, this in the presentation. So I don't know, Ayben, if you can put full screen for the. Because now I can see the right banner, for people to see it. Cool. And now in okay. Full screen, like Control L. No, Control L in the. Did you say Control L? I think that you will have it. Great. So if we can see the previous slide, please. Yes. So basically, the map of the talk, and I will be happy to of course, to go into a Q&A after or whatever topic you feel that is more of your interest. So basically, I will be talking about first how this, as I was mentioning before, how we are in the new world of international relations, and basically well, maybe in a more unstable or at least a more situation in which you are subject to more geopolitical shocks. Geopolitical shocks can be related to the Russian invasion of Ukraine, can be related to other situations like Brexit in the case of Europe, the European Union, country leaving, and the trade war between the US and China. That in a way, I mean, this adversarial nature of the relations continues nowadays, no? And we see it every day. So there are all these elements of different nature that really contribute to this new landscape. And in this context, a key, let's say, paradigm in which we live only, let's say, 3-4 years ago, 5 years ago, of if you open your economy, if you open your finances, if you go, then it will be better for everybody, provided that we have like a common understanding of the rules governing this, and World Trade Organization. If you have a problem exporting to one country, you have a firm, you can go to a place where you can really go against a certain government or another government, where you can solve conflict between different countries or firms in different countries. So it's a common order in which we all trade, but not only trade, goods, services, technologies, everything. So we're moving somehow, or the narrative, let's say in policy circles for sure, but even in the academia, is moving from a narrative in which, let's say, openness was a plus, and the European Union is kind of the as you may know, is kind of the champion of, let's say, economic and financial openness, to a situation in which this openness turns into somehow dependencies or vulnerabilities. No, and this was quite clear. I mean, with the conflict in Ukraine, in which you see that the dependencies on energy of the European Union, where you trade and you trust partners, get broken, and then you realize that important parts of the European Union are extremely dependent, or were extremely dependent on Russian gas, and if the supply goes up, then you're in trouble in a sense. No, you have to, and then we said, okay, but this is just one example, and one sad example, no, and has been very important. But there are many other elements, no? And this is something that we look in detail, no? And we'll go through that. No? But then, of course, I mean, when you think about this new narrative, in this new narrative, countries, or in this case, the European Union as a whole, react with policies. Of course, I mean, these policies are not a free lunch, because we are talking about a new paradigm. So this new paradigm, if you apply policies that come from different times, in the sense protectionism, industrial policies, then you can have also some unforeseen or some unwanted effects. So there are a lot of trade-offs when you think about this issue. And in the particular case of the European Union, this can bring, I mean, this has to be really thought through in this case. No? And this applies to many countries. I mean, can apply also to the way Turkey looks at the war. So this has a lot of implications. No? And in the particular case of central banks, but I will be touching on that only tangentially. Of course, I mean, this has implications, not only for the world in which monetary policy operates, because now you have bigger shocks, more volatility effects, but also the way in which certain key macroeconomic variables operate. No? So inflation is going to be more persistent if we have this process of nearshoring, of the construction of globalization. If this ever happens, then will the price level be higher? Will we be in a period of very high inflation and very persistent for a very long time? So there are many questions that arise when one starts thinking about these issues, and this is important. So in particular, in the next slide, no, you can see just a couple of examples, no, how these geopolitical considerations are affecting, you know, these economic relationships. And so there are many examples in the paper, and I've given some examples, but just to put it in one chart, in the left chart, what you have is an index of global uncertainty. And you see that, I mean, this is constructed with text analysis, but the important thing is that, let's say, this measure of global uncertainty in the world just goes up. Let's say, we're in a situation in which uncertainty about economic policies of other countries, uncertainty, of course, I mean, about geopolitical events, uncertainty that also transmit within countries and across countries in inequality, in social tensions, in polarization, this is increasing. This is on the rise. So maybe we're back to how the world would be in the last 30 years, or just an example, no, or a parenthesis on an oasis, no. But the key thing is that we're in this more troublesome world. But the problem is that when you start thinking about the future, and you say, okay, where do we go from here? And you try to think about a world in which, let's say, even though one can have, barriers, frontiers, groups, preferential partners in trade or whatever, the fact is that we are as a world. I mean, when you look from Mars and you look at the world, at planet Earth, we are extremely integrated. So thinking about these elements of geopolitics that may lead to fragmentation, because we see this crisis of the multilateral order, we see this crisis associated to the World Trade Organization, in which even some legal guarantees, like the judges that had to look at this conflict have empty positions. No? But when you look about that, it's very hard to really think about the future to which we are going. I mean, it's going to be a very dystopic world. Where are we going? And the fact, and this is key, is that when you think about probabilities, I mean, at least, I mean, when you throw a coin and you have, okay, can be, 50-50, one side of the coin. And we know that. I mean, if it is a coin that is not, it's a normal coin and atmospheric conditions are fine, you know that when you throw the coin, you're going to get 50% or 50% from one or the other side of the coin. But when you think about scenarios of fragmentation in different levels, we are facing a situation in which we cannot even put probabilities to the events. Where are we going? Am I going to go to a world in which there are two big blocks and then some countries which are, non-aligned? Or what's going to happen? Everything is going to continue. It's going to be. So thinking about the scenarios is very hard. No? And for example, when you look at the right-hand chart, what we do with some colleagues, I mean, did in a paper that is we have a box in this kind of a broader paper. You think about the situation in which you say, okay, I have one of these trade models, these gravity models, in which I can kind of represent fairly well how all nations in the world trade. No, let's imagine conditional on tariffs, on whatever, all elements. So then I have this model, and then I think, okay, let me think about some future through the lenses of this model. No? And what you have there is a situation in which we assume that trade tariffs go back to the era of the Cold War. So when the Soviet Union was there, so we go back to the Cold War, where tariffs were much higher, but countries still traded. I mean, so there was a flow of natural gas from the Soviet Union to Germany. So it's not a and you say, okay, let's put this situation, but let's not assume that the world stopped trading. So we're trading, but we're trading has more costs. And then we look at the European Union, which is the chart that we have. We could look at other areas, but just to simplify. And then you see that that trade really falls by more than 1/3 with, let's say, with different blocks. And you can kind of classify countries according to how countries vote, for example, in United Nations. No? So you create like some measure of political proximity. No? So this is just one example, and there are many others. But the issue is that it's very hard to think. No? Of course, I mean, we have one recent example, sad example, and if we go to the next slide, in which we see we can envisage a scenario of fragmentation, no? And this is the case of the recent case of Russia. Of course, I mean, from the European Union, the US, other countries, we put sanctions due to the invasion. So you have immediately, I mean, a drop of trade in many goods, and I mean, not on everything. So we are not close. We still trade, but not on energy, on many things. You know that, and also on finance there are restrictions. And what you see is that with these red colors is that there is some reconfiguration of the countries, and you see that there are also the position of Turkey, in which, let's say, some trade that was done before, with some parts of the world now are changed to other parts of the world, but with an overall loss of trade. So let's say we are worse off in this situation than we were in the situation right before the crisis. But I mean, this is one example of the world to come if things develop in that direction. No, but still, I mean, we're in this world in which it is very hard. I mean, to really assign probabilities, to think about the future, to think about these dystopias in which we could be. No, because let's say we can imagine this is as far as our imagination goes. No, so in that sense, the role of in this case, no, there's more for a student, the role of tools like models in which you can have like a fair representation of reality, at least in some dimensions, like trade, and then do simulations to see, okay, what happens, which are the losses, or which is the situation, or how are trade flows going from one country to another in this or this other scenario, are very important, and for in particular for policymakers. No?
And also here, I want to add something. So this percentage changes are for the whole volume of the import. So, but some of the sectors may affect it deeply, yeah? Absolutely.
This is a very good point, because this is just exactly like raw flows, no, of imports coming but of course, I mean, you have many dimensions here, no, as you were saying. First thing is, we're not very connected. So it's not that we produce a car in Spain and the car is exported to Japan, no? But is that some part of the car is produced here, another part is in Turkey, another part is in... And then, so we're kind of connected through global value chains. So the disruption through global value chains, just if you have one element which is not coming, can kind of break up the whole value chain. No, this is one important element, no, in that direction. No? And the second thing is the centrality of the item. No, so if you don't receive, for example, energy, simplifying, no? This natural gas flow, then maybe many industries are not going to be producing anything. No, so then you stop trading just because you are not receiving something. So, but you can produce. So nothing happened to your physical ability to produce a car or whatever else, no, another machine. No? So this is very important. No? So this is really a very lower bound of the damage, of the collective damage. Let's say that these fragmentation scenarios, of course, beyond, I mean, issues related to the war. I mean, this is the thing. So it goes without saying, no, that this is there, no. But in particular, from the economic point of view, I mean, the damage, let's say that fragmentation scenarios may create is very important, no. And also, this has many dimensions, no, as we'll see in the next slides, no, in that direction. So we can move to the next one. Yes. So you see, I'm talking here about the European Union, but I mean, you could replicate for different economies the fact that if you look at these fragmentation scenarios, then of course the dependencies of your economy, things that you had to buy from other places, acquire a different feature. So it's not about the competitiveness of your firms or whether you want to be more open or less open or whatever. It's also about, let's say, this kind of strategic autonomy. You know? So from the EU point of view, as I was telling you before, the EU is very open, it's very pro multilateralism, everything. No, so that's why they say this is look at through this open strategic autonomy, and the open is not something that you know, it's very well thought of. No, it's just like open because, let's say, the first best would be that we all keep trading, keep you know, people move freely from here to there, finance flows, someone can invest here or there. This is the first best. No, now if we are in second or third best, in which the geopolitical shocks are important, then you have to characterize this thing. No, and just one example on the left chart. If I can see it very little, no? You see, for example, this is data for 2019, but this has not changed much with the most recent data. The point is that some trade data, you know, to have the structure and to go into the very product, so to have very detailed data, you have to go back in the past, no? And then you can update some parts, but the structural dependencies or structural linkages between economies are kind of relatively stable, except in fragmentation scenarios, no? And you see in this left chart, for example, in energy, that more than like 55%, and now, I mean, if you update that, this is more like 60% of all the energy that is consumed within the European Union is comes from abroad. So it's not only natural gas, it's oil, it's basically everything. So it's 60%. As you look at some other economies like Spain, it's more than 70%. If you put the energy that comes from other European Union countries, 75%. No, and I guess in the case of Turkey, for example, it is also a big number. No, like from what no? But beyond these broad things, because you can look at these bars, and some of the bars, okay, are important. It's 20%, it's something, no? But it's not that big, no. But this is not really the best picture of the problem we are talking about, no? Because there are other elements, as Ayben was rightly pointing out. One is what you see in the right-hand chart, that is how much of this trade is concentrated in certain countries, no? And then for the case of the European Union, basically, in particular due to manufacturing, you see that the biggest trade partner, the largest by far, is China. No? Then you have the US, you have Turkey is around here. No, it is an important partner, so it goes into the. But there is a big concentration. So this means that the more, I mean, not only in imports, but also in the way we sell to them. So we export. No? So we're interdependent. So this means that if something happens, then of course, I mean, you have a problem because you have this concentration. But again, concentration is only one element of this point. And as you see in the next slide, if you really want to see the best.
Before going to next slide, I want to add a few information about Turkey here.
Yes, please.
Also, our energy import dependency is more than 75. It's very high, but there are many new investments in Turkey to energy sector, so it will change by time, and it's changing by time. And also, I want to add that for Turkish economy, the European Union is very important for our foreign trade. So you have also shown us that we are in the sixth level for European Union, but European Union is very in the first steps for first levels for Turkey. Is very important. It's very important market. So if there are bad news about European Union, it's very interest us.
Absolutely, no, it's very relevant. Thank you. No? And it's like that. So you have like this issue. You have concentration, and you have also. I mean, when you look also at trade, also at bilateral trade between European Union and Turkey, one thing which is very important is also, let's say, when you think at it from this vulnerability point of view, no. So how vulnerable am I if suddenly I stop having Russian gas? No, this is a bit the natural gas. No. And it's what you have here. I mean, this is a very complex chart. The only thing that you have there is the same charts as before, but at the level of products. So there you have watches that we buy from Switzerland, insulin that is bought from the USA, things that are important, no? Like photovoltaic cells that you need also to build other things, no? And this is very important because, for example, I mean, think about the energy, no? So you say, okay, I import a lot of energy from abroad, then I can have domestic energy. One source of domestic energy, what is? I mean, we're Mediterranean countries, the sun, no? So we can take the energy from the sun, we put these solar panels. But then when you think about how solar panels are built, then first, I mean, you need to buy the solar panels because typically, I mean, basically we buy all the solar panels from China. Then you move into a different dependency. So you are not bringing natural gas from Russia, but you are building this from China. This wouldn't be a problem in a world of respect of multilateral order, but of course. But then also for building the solar panel, you need some rare earths and some type of material, specific material that are also concentrated in other countries, no? So in that sense, when you look at this from the product point of view, you see that beyond concentration, which is like what you have in the x-axis, no? So this means that when you move to the right, this one means that basically all insulin, which is what you have in the top left part, is basically imported from the US. 100% of the insulin that is consumed. But then when you look at another dimension, which is a scarcity, this means your ability to produce that things that you are bringing from abroad. No, you have these big balls here. I mean, the one color, in which, and this is oil. No, so basically, this is not very concentrated because you can buy, oil from many places. No, you can buy from Qatar or from Russia or from the US or from Brazil or whatever. But it's very high on this axis. Why? Because within the European Union, I mean, we basically don't produce that. So we cannot substitute that. We can substitute other things, maybe tomatoes, I don't know, that you bring from here. So there is the dimension is how much can you get out, or can you insure yourself against these vulnerabilities, no? So, and it's problematic because when you think as an economist, which is, you tend to think about the more, let's say, optimality conditions or optimal situations. Here you have to start thinking about how to insure against certain risks and how you reduce your vulnerabilities. No? So we can move to we can even skip the next one to go, and we can skip that and go to the next one. Yes. So basically there are many dimensions. The one before, I will not go to stop because it's a very complicated chart, but says that, of course, I mean, also when you look at this from the risk insurance point of view, you have to take into account this issue that I was talking before, which is this political proximity or political alignment. No? And this is very important because when you look at concentration, scarcity, and these things through the lenses of who is your partner, I mean, who is the one you are selling and buying, then things can change. If you take the geopolitical stance that I was telling you before, it's clearly second best. No? We see that we all lose in this world. No? But then there are other dimensions which are important when you think about the integration, because sometimes we talk a lot about trade, but then you have trade of goods, but also trade of services. I mean, think about, I don't know, now we can, you can buy a service of supercomputer, like cloud computing, and you have a company in California, and you can like have a process computing in the cloud. So you are buying a process. So I have my programs, I run them. I don't need to have the physical machine at the Bank of Spain to run the program. So I'm not buying the physical machine, I'm buying cloud services from the company that is in California. So this is trade in services. No? So, and we're more and more integrated in services. You have programming coders in whatever country in Asia, which is writing code for a company, which is, so nowadays, integration through services is much higher. Also, the service content of goods is much higher. And the other dimension, which is very important, is integration of finance. No, finance in the sense of direct financial investment, banking. I mean, so for example, I mean the banking linkages between Spain and Turkey are very important in a sense. So basically, what we call from the bank, from the supervisory. I mean, and putting my hat off as a part of the central bank, which is supervisory. Turkey is what we call a material country for the Spanish banking system, because the linkages are very important. No? So we're intertwined on finance, and this is very important as well. No? And in the next slide, the other point I wanted to make is also that beyond finance, let's say financial flows, we're extremely integrated, again, for good, no? On payment systems, on financial market infrastructures, all of us, I mean, and sometimes in ways in which we don't think about. I mean, you will have a Visa credit card for which you pay them, but this is a service provided by a company which is in the US. So in the US, sanctions your country and you cannot use Visa, then you cannot use. You don't have many alternatives as payment systems. No? And this was something that, from the point of view of the European Union, this was kind of a wake-up call in this issue of political alignment, or because in the case of, for example, of sanctions to Iran, some years ago, so the stance of the European Union was not as tough as the one of the US. This means that some European companies were still trading with Iran as a country, but at the end of the day, were subject to secondary sanctions, let's say unwanted secondary sanctions, because of all these payment systems, which at the end of the day belong to some US companies. No? And the issue of secondary sanctions, it might be a key one also in the current circumstances, because I mean we're really intertwined. No? Think about the dependence or the interaction on big tech, on crypto assets. I mean, how these things are moving through many different channels, cybersecurity, etc. No? So these are things, systems, distributed systems. No? So it's very important also from the finance point of view. And finally, on this dependence things, in the next slide, what we see is that we are also quite intertwined in the flow of people, and this is very important in a world of knowledge. So basically. And there are two trends. I mean, there are two charts, but I'm not going through that. First thing is that geopolitical shocks create movement of people through frontiers, which are a bit changing in nature. No? So in the left-hand chart, what you have is, let's say, net migration within the entering into the European Union. The blue line is net migration, it's a more economic migration, economic social migration. And the yellow line are asylum seekers. And this is related to geopolitical shocks, and this is increasing. So this changes a bit also how people interact. But the second thing is how the labor market globally is moving, in which you have high-tech people, I don't know, a lot of people from IT in India, and then this changes the flow of workers through countries. So if there are problems with the flow of people through countries, there will be also problems or frontiers to how knowledge or skills or experience really move around. No? So this is another dimension that's typically out of these debates, but that to us was very important. So on the European approach, I can be very brief, and we can go into more details in the discussion. So basically, in the next slide, what you have, and I can kind of send this in the because again there's a lot of text there, no. So basically, the approach of the European Union, you can see, I mean, when you look at it globally, for example, you can think about the Chinese, like this road and belt approach, or you see this so-called Inflation Reduction Act of the US, which have a lot of, let's say, how would they say, like protectionist pulls insofar as they go a bit against the rules of the World Trade Organization, because they prioritize national companies or the production of certain elements with according to the multilateral rules that all the countries sign, let's say, were not appropriate. No? But the problem is that we don't have a court to go, because the court of the WTO is not operational nowadays. No? So you have this issue there. No? So basically, in this world, having the European Union as a very open economy and very, let's say, open-minded in that sense, I mean, like for whatever reason, I mean, you can think about the motivations or whatever, but in practice is kind of the champion of openness. No? So basically has been taking measures in 3 dimensions, always like in a very cautious way. No? So the first part is how to preserve this international level playing field, meaning that if you open your markets to countries that can apply or can buy a strategic infrastructure like an airport, then should you be allowed to do the same, in the other country? And this is not the case so far, So this you have to kind of adjust a bit the way that this bilateral way that is approached. The second thing is how you make the European economy, the European Union economy, more resilient to these shocks. It can be this this war-related shock, but it can be also a COVID in which you have like suddenly a breakup of, or at least a push in certain global value chains, and you want to be ready to cope with those shocks in a better way. No? So it's kind of and this means that, for example, I was talking before about this rare earth or this lithium or whatever. No, so if you bring all these particular and very important strategic materials from one single country, and you need that if you want to do this ecological transition, because you want to build these solar panels, then you need to find new partners if you don't want to depend on only one. No, because before maybe it was optimal to have only one, but now you need more. No, so basically there is also a whole strategy when you talk to European Union authorities trying to have this resilience. No. And the third issue related to the first one is how to respond to what is called like a geopolitical threats, but not in the, again, we're in the economic domain. We're talking about economics, no? And this has to do with for example, anti-coercion measures, no? Where you have like suddenly that one European Union country is receives is coerced because it has a certain position on a certain geopolitical issue. Then you have to have ways of let's say trying to make that fair and react. No? And this is a bit the whole thing. No? And the issue, and this is a bit the final to last point I wanted to make, is that all these policies, when you think at it from the point of view of a global player like the European Union, which is this world of giants, no? You have China, the US, Russia, impose trade-offs, no? Because of course, I mean, if you try to protect you do some you want to be more resilient, you say, okay, being more resilient means producing more within the European Union, no? This is industrial policy. But then, okay, maybe you smooth external shocks, but then you are more exposed to internal shocks. So this means that, and then when you look at history, typically, I mean, the volatility, at least over the past 30 years, the volatility of internal shocks is higher. I mean, think about the pandemic and think about these confinement measures. If one country, China, is confined, when it closed, then of course, I mean, industrial production in the European Union will fall heavily, no, by between 5-10%. And for firms that were like more exposed to China, it fell by almost 1/4 of production. But it was transitory, no? But at the same time, the other 75% was produced in many places. If you have all your production in your country and you had to confine your country, then you produce zero. No? So this is just one trade-off in which you have to say, okay, then I'm more exposed to this shock, but then less exposed to other shocks. The second element that can miss here, it's like a general welfare in terms of inefficiency, more monopoly within the country, compare higher costs for the consumers, for everybody. So all these policies, trade-offs, so policymakers should really look at okay, if I do this, I reach this, but then I have this, the pros and cons. No, I mean, this is like the economist business, so at least to say, okay, on the one hand, on the other. So these policies have the potential to have significant costs. No, this is important. No, and then I think I will skip the next one because I basically went through them. So if you can like move like 2 or 3 slides to the end. This one, and then the next one, and another one. Yes. I will go to this last point. No, this is, so basically, I'm saying that there are trade-offs, no? Protectionism, increased margins. So you say, okay, now I have my production in home of microchips, but maybe I'm very inefficient producing microchips. So when I'm producing current generation microchips, then in Taiwan, they are producing 7 generations ahead microchips. So then I'm more efficient, then prices increase, and then I have more monopolies within my country. So there are a lot of trade-offs that have to be applied. In the case of the European Union, of course, I mean, there is one gap, but I won't go into details, which is the fact that we are like a very incomplete monetary union, when you think about the euro area. So there are ways of reaching the same target, which is being more resilient, just by further integrating. No? But this is an issue which is quite specific, so I won't go. No? And then finally, I mean, to close with this intervention, and just to go back to central banks, but to put it more into a more general macro perspective. No? So the way in which these policies, no, that induces a lot of trade-offs, have a very disruptive potential, no, in a sense. No? The fact that maybe we are going to be moving to a second-best situation due to this geopolitical situation, but these policies taken by the different countries, all countries are like reacting in one way or another. No? So this means that the way in which we think about capital flows, or banking integration, about price dynamics will change, because we think about that things in a different environment. And just to put one example, and then I will close. Think, for example, about inflation. No? So you say, okay, now I want to make this environmental transition, because I want the world to be cleaner. And in the case of very dependent countries like Turkey, like the European Union countries, like Spain for sure, because also, I mean, if I move in that direction, I will be producing energy with the sun and not producing energy that I have to bring from some other country. No? So you have even the self-interest. So you have like the global interest of the world, but there is also like an economic interest that had to be pursued. No? But then, of course, I mean, you enter in, this is just one example. No? But then what are the implications for the price level, no? and for the inflation rates when you look forward? No? Then this means that we're going to be in a transition in which energy is going to be more expensive. Then you have a permanent increase in price level. And then in 20 years, this is going to be cheaper. Are going to be in a situation in which in this transition, I'm still dependent 70%, 80%. We're talking before, I was giving the number for Turkey. And then I'm going to be subject to these inflationary shocks that are supply shocks in this transition. So I'm going to be in a world in which inflation is not only higher, but it's going to be more volatile. So then the job of the monetary policy maker is going to be more difficult, because you have to try to extract the signal from the shocks, and then supply shocks are complicated animals. So there are many economic questions on which we have to think with different theories and we have very little evidence. This is the problem. No? We have very little empirical evidence to really think about these issues. But certainly, I mean, we have I don't know if these are for sure are going to be worst times in one dimensions. But at least from the intellectual point of view or economic point of view, I think we're going to learn, and we are forced to learn a lot and to understand this new phenomena in a better way. And with this, I'll conclude. Thanks so much for your attention. Thanks, Ayben. Back to you.
Thank you so much. And your email address is here if anyone needs to ask any other question later, who watched this webinar later can also reach to you. Thank you so much. During your all presentation and all the information that you give, I was always comparing with Turkey. Because you know that Turkey is between Europe and Asia, and the geopolitical factors are really affecting us. Now maybe you have just come to face to face with a war in Russia, but in East there's always a turmoil, and there's always a war in the East. And also in many sectors, and in the beginning, the dependence about energy is a very important problem for us. So in today's economy, we are not able to produce everything. We all need to be in the foreign trade, and our financial systems are open to many shocks. So it's not easy to be to have strength in all areas. And also we are one of the most fragile economics, maybe in world. So for Europe, the European Union have a strength, but still the European countries face to face many problems when we come to economy. And so thank you so much for this picture. Now I have stopped the presentation, and I have a question for you.
Cool.
So we all I know that you have a PhD in economics. Maybe you have some more interest in some of the areas in economics, but we are all talking about recession. And today also there was an indicator for GDP for Germany as recession. So do you think the European Union will have a recession problem in next years, or we shouldn't be in such thoughts, because or in financial system, are we too much panic for those types of information?
Complicated question, in particular when you're recording, in particular.
You don't have to answer.
No, I can.
Every day we are talking on these questions. Will the world economy be in a recession, or will European countries be in a recession? And today is the first day that's coming, because Germany is a very important economy.
Yeah.
In European Union, it has got a very strength. It has strength in many areas, and many of the Turkish people lives and works in Germany.
Yeah.
So many of them are going to Germany to work there. But today we had a better information, so I want to ask you how about your thoughts on this problem? Do you think if we will have this problems for a few quarters, or it's only for one time? How do you think about it?
Yes. No, I mean, think about so if I can take a step back, no, and go to your question. I mean, think about the scenarios that we're displaying about in particular the German economy or the Euro area economy in particular, like 1 year ago, no? So 1 year ago, basically, the scenarios were very dismal, no? Because of course it was not only about it was basically cutting, reducing drastically, the energy supply from a regular provider, from which these dependencies, as we've been discussing before, were very high. First thing. So really, the economic prospects, or the probability of a recession that international organizations, for example, I got involved also within the European, the ECB, the European Central Bank. So we collaborate go into discussion, to the generation of projections for the Euro area, and these discussions. But when you look at the private sector forecast, everybody was really painting in the first half of last year a very dismal scenario. So we have scenarios again. I mean, coming back to this issue of not being able even to put probabilities, because was this energy crisis with increasing prices, huge increases in prices, were they going to come accompanied by physical cuts? So this is not only that you can buy very expensive natural gas, but the point is, can you even buy natural gas? So this was basically the question 1 year ago, and then the scenarios when you think about, okay, then if I have a disruption of energy, and the little energy that I can buy, I have to buy it at this huge price, then I will be really, in a very deep recession. So this was a bit the world. Then as things evolve, we've seen that at the end of the day, let's say not only the Euro area economy, but many economies around the world have shown to be more resilient than we thought. Why? In the case of the Euro area, and I'm talking about the Euro area, Germany, or the European Union in general. First, because the energy shock, of course, was huge, but then prices began to normalize in parallel to a situation in which part of this normalization was accompanied by like a substitution of sources. So now we're buying more expensive liquefied natural gas from the US, coming from Texas or from Qatar or from Nigeria, but we're able to buy that. So there was no shortage, there was no rationing of quantities, In any case, at the same time, the huge costs of firms, of everybody, was important, But it was better than expected, This is one thing. Then the second thing is that, of course, with so many things that happen, sometimes we forget that we had the pandemic, That was a very sorrow event, So there was this period also coincided with the normalization in which many European citizens and in Germany have accumulated a lot of savings during the worst part of the pandemic. So this additional consumption that was supported by savings was a good buffer, to really cushion the effect. Second thing. And then, of course, there was a lot of public intervention, like, subsidies, fiscal policies, transfer, and whatever. So this kind of cushioned a lot the impact. Of course, at the same time, we had this inflationary crisis. Then when you think about the future, so this means that we've seen like a significant acceleration of the German economy, of the Euro economy, but we've seen some quarters negative growth, very little negative growth. But even compared to the most recent projections that were published by the Europeans, let's say by the Eurosystem, the last one were published in March in the context of these exercises that we do. The figures for Germany, for the Euro area, were better than expected, even compared to this March. So let's say there was a support of the economy that was kind of surprising, and it's kind of related to these elements I was mentioning before. Now, what will come? Which is a bit the big question for economies. So what is to come? The issue is that we've been increasing interest rates. All economies through all the world, let's say, to cope with inflationary pressures. So of course, this has a drag with a lag on the economy. No? So this is a factor, and this is global. No? This is on this side. On the other side, it's true that commodity markets are kind of normalizing. Even food price, I mean, this is something that we have not touched about, but it's very important for inflation everywhere, no? Like food inflation, and this is kind of, again, I mean, it's still high, but it's kind of loosening steam. And the other issue that can go in the direction of improvement, I mean, so we're in this deceleration issue because of this monetary policy contraction, also the still, I mean, the lag effects or the effects of this geopolitical uncertainty in a sense. But the big uncertainty that can explain whether the recovery from this bottom up, I mean, would be like a stronger, less stronger, comes from the foreign trade in this sense, and in particular is the case of China. So China is kind of a very important player for everybody in the world. And so they went out of this zero COVID policy late this year. The economy has been surprised on the upside since the beginning of the year, even though the latest figures are kind of weak. So in that sense, I mean, we have a lot of uncertainty. But there are like factors that push in different directions. No? And from the point of view, let's say, if you want like a recession, I mean, this is not in any forecaster's view nowadays. This doesn't mean that it cannot happen. Of course, I mean, we know that we're going to make a mistake, no? But when you look at ECB projections, private sector projections, consensus, what you anticipate is in this context is like a period of slower growth that little by little, I mean, will kind of go back to potential. No? So this is a very long answer to your question. No?
Yeah, but it's very important to listen from your perspective, because you work with also European Central Bank, and your knowledge about these issues are very large. I have a few questions too, and also I want to share my thoughts too, especially for the interest rates and the inflation, coping with inflation. I think there will be a balance somewhere, and when we see that balance between inflation and the political interest rates, then the central banks will begin to decrease the interest rates. And also, I'm thinking that after mortgage crisis in the global crisis, Spain was one of the most affected countries in Europe, with Portugal, with Italy, with Greece. So, and I remember that it was mostly related with your banking system. How do you find your now banking sector as totally, when you compare with your crisis? It was a very different crisis. It was all finance sector. It was all related with finance sector. But if your banking sector is powerful, so it's easier to cope with the other issues too. How do you think now about your Spanish banking sector total?
Total.
And also you work in Spain.
Yeah.
I'm not sure how if you can tell everything with your own thoughts, but
no, I mean like I said, the governor, the top officials, say from the system have been very vocal on that. No, so and it's quite natural. I mean, the question is quite natural, and also the fact that, of course, I mean, we've gone through this kind of, I would call it financial banking turbulences, no, related to these banks in the US and in Switzerland and so on and so forth, no. But the point is that in the current situation, compared to this old crisis, in part, as a reaction to the previous truly proper, I mean, deep banking crisis, worldwide actually, there was a lot of legislation that came through. I mean, in theory, to prevent the next one. I mean, we know that, of course, I mean, you have a crisis, and you have legislation to prevent at least a crisis that is similar to the one that you face, no, in that sense, no. But at least from when you read or you discuss, I mean, with the experts. So basically, this legislation, which is in place, have made the banking sector, I would say globally, but in particular in Europe and for sure in Spain, in that sense, like more resilient, because then you have a lot of this ratio of the capitalization is significant. Then you have the supervision, prudential supervision on it. actually supervision, let's say the Spanish dimension or the German dimension or the French dimension, when you look now at banks within the euro area, is different because typically, I mean, systemic banks, like the big private banks, are also, I mean, supervised from, let's say, from Frankfurt, no, in a sense. So this is a joint venture, but, you know, like the procedure, the capitalization of banks, let's say the tools to be more resilient in case of a shock are there in place, no? Again, I mean, it doesn't mean that you cannot have a shock and unforeseen, no, but the situation, it's kind of the ground is kind of solid, no, assumedly, no. And then in terms of the, of course, and you were saying very rightly, no, that of course the banking system is very important. I mean, for all this, for the economic situation in a sense, no. And that's why I was mentioning before that, of course, I mean, you had this monetary policy tightening, no, and the way that typically, let's say, in an economy like the euro area, like this tightening of the policy rates go to the economy is through the banking sector, no? Typically. So it's through credit, no? And then there are two things that when I was talking that this can be contributing to the acceleration, and this is intended because I mean we want to rein on inflation, no? So this is a bit it's not that you say okay, increase interest, and then I see that the economy is accelerating. And let's say this is the intended consequences of going into this tightening of monetary policy, no? So it's one that is transmitted into, let's say, the cost of loans for consumers, for firms, for everybody. So this is one channel, no, through which it goes through prices, let's say, through interest rates to the economy. So it's most costly, I mean, now to get a loan. And the second thing is on quantities, no, and this also has to do with the way in which also banks move to a situation in which growth is lower, no. So basically, that the concession of a loan to a household or to a firm is more strict. You know? And when you look at the statistics, let's say at the data on the supply of credit, then this is also tightening. No, so basically, let's say through the banking sector, in terms of the cost of credit and in terms of the actual concession of credit, then they are tightening. Let's say following this monetary policy tightening, of course. No?
Thank you so much. Dear Javier, there are other questions, but nearly for an hour you are speaking and you are very tired. I know about that. It was very nice to see. Your presentation was very full of information. It has a good view about the station, and also thank you for answering my other and my friends' other questions too. Thank you for your time. I hope we can also have you a guest here in Istanbul, in Turkey. I hope one day you will have a face-to-face conference here with our students and with our colleagues too. Thank you so much. Is there anything that you want to share with the people who now on watching us and will watch later? Do you have any other sentences lastly to say?
Okay, no, I mean, thanks again you for the opportunity to have this dialogue with you, and also to the audience for watching. And as you were mentioning before, so the email is there. So if you have any doubt, questions, or anything, I'm happy to come back to you. Thanks so much for the attention.
Thank you so much. Okay, thank you everyone to watching us, and I say bye-bye to everyone.